All right, let's get back to the markets now and check in with Michael Lee, Chief Market Strategist at Michael Lee Strategy. We're also joined by Brian Sazi and Jared Blickery. Good morning to you all. Michael, I'm going to start with you. There was lots of news this weekend about that continued disconnect between what's happening on Main Street and Wall Street. But one thing that has been happening is the breadth of this market, the breadth of the rally has now broken out. It's not just about tech and big cap tech stocks anymore. Does that mean that perhaps there's a little more conviction here and maybe this rally has more legs than we thought?
Yeah, look, I think we're at the beginning stages of a multi-year bull market. And I think based on the actions that the Fed has taken and the amount of liquidity in the market, specifically M2, if you go to the Fed blog and you look at the growth of M2 since March, it is just astronomical. It's growing at like something like 30 or 40% year over year. With that amount of liquidity in the system, stocks are just going to go higher. We're also seeing a much quicker recovery than the rosiest of expectations. What I find remarkable, particularly, is the continuing claims. We're still looking at, $1.4 to $1.6 million initial claims on a weekly basis, yet continuing claims are dropping, which means a lot of people are going back to work. And as the economy opens up further, this reopening and the acceleration of the economy back to some sense of normalization, it's just happening much quicker. And you saw that from the Chicago Fed this morning with a positive reading. Granted, there's still all sorts of trouble and there's all sorts of problems in the underlying economy. However, the market is a forward-looking instrument, and we have seen continued surprises to the upside across all economic data. And then when you factor in what the Fed has done for the capital markets in terms of essentially backstopping the liquidity concerns of the S&P 500, you are now looking at permanently high multiples. Permanently higher multiples on a lot of these companies because there is no bankruptcy risk for many of them. So as a result, you're in a situation where stocks are going to be worth more, the economy is growing quicker, and with interest rates going to zero or near zero, you're left with very few options to grow your capital.
Michael, walk me through this hypothetical scenario. Let's say a client calls you up and says, hey, Michael, President Trump said at the Tulsa rally this past weekend, that my 401ks are going down if I don't vote for him. What's your response?
I'd say, look, that's a tough one to answer. I think that President Trump is far better for the economy. Okay. And when you had an Obama-Biden recovery, it was decent for the financial markets, and it's not so much the 401k, it's those at the lower end. If you look at if you look at the unemployment rate with those of the lesser education, you went from the kind of the greatest wage growth, greatest employment growth in the first 3 years of this administration. Compare that to the prior 8 years. So the problem with the Obama-Biden recovery, it was good for everyone who had a college education, everyone who had financial assets. Okay, that's already happening right now, and that's going to continue. It's a lot harder to sell and to say, hey, if you're broke and you didn't go to college, you're a lot better with me. Okay, that's what history shows. That's what I think will continue. But it sounds a lot better that your 401k is going to be doing better with me. So I don't know that that's a completely false statement, but it's hard to prove and hard to articulate. I think financial markets are on their way, and they're going to be on their way for several more years, regardless of who wins. I do think for the overall economy, a continued Trump administration will benefit the masses more than those with the financial assets.
Michael, some breaking news crossing the wire here right now. I'd love to get your reaction to it. Disney says it's going to open its Disneyland Paris on July 15th, as, of course, with all the precautions, the social distancing, the masks, the temperature taking, what have you. What's your take on Disney right now, which, for as varied as its business is, has been hit so hard by this pandemic because so much of what it does has to deal with people gathering in places and crowds?
So I think those parks are going to be packed. I think they're going to come back strong. I think you could see it from the cruise lines. Cruise bookings are up like 50 to 70% for next year. People that love Disney are going to continue to love Disney. I think we're in difficult times for those over the age of 65 with underlying health conditions. You know, their quality of life until there's a really solid therapeutic or even a vaccine is going to struggle. For the rest of America and for the rest of the world, it's time to get on with our lives. I think a lot of people are going to be out and about. I think the problem with Disney is an ESPN problem. And the fact that there are no live sports right now. And unfortunately, I think this Major League Baseball standoff, okay? Major League Baseball had an opportunity to capture the entire country, entire nation, re-engage an entire generation of people into baseball. And the fact that they can't come to an agreement is not only a huge blow for them, it's a huge blow of ESPN. If there were three or four baseball games every single day going on right now, people would be glued to ESPN like you wouldn't imagine. And that would do a whole lot for people signing up for ESPN Plus, their streaming service, as well as engage with cable carriers, because there'd be something to do. And when people sign up for a lot of those things, they stay engaged. So the problem I see for ESPN or for Disney is an ESPN problem where sports viewership is declining. It's too expensive. They've overpaid for a ton of contracts. It's a huge portion of their revenue. And then also they can't come out with movies. They can't produce movies right now because everything is locked down. I think the parks coming back I think that will surprise the upside with attendance and revenue from those parks. But I think as great a company as Disney is, there are structural issues at bay with them.
All right. So you're saying ESPN is Disney's big problem. What do you expect to see there? Do you think we're going to see mass layoffs at ESPN, a major restructuring there, perhaps?
I just think it's going to be a continued overhang on the stock price where revenue is going to decline. And, you know, you can fire whoever you want, but if you've overpaid for sports content and there is no sports content on multi-year agreements, okay, and there's going to be problems this fall with, it looks like the SEC is going to play football, but who else is going to play football? So until these things can get back on board, and until they can kind of address the fact that they've built a business model that is unsustainable. It is not going away, but it's similar to a newspaper model where people are going to continue to cut the cord. And until you have that high level content drawing people into your subscription service, it is just a massive structural issue. And you combine that with the fact where it's very difficult to create new content for their other streaming platforms and at the box office. Okay, this is a real problem for what has historically been one of the best run companies in the world. However, I think people are going to surprise you with their love of Disney World and their ability to get back out there and go on, Splash Mountain or whatever.
Yeah, we'll see. We'll see if that's enough to offset the issues over at ESPN. Jared, I want to get over to you because I want to stick with this theme of the reopening trade, right? I mean, you've got Disney stock to look at, cruise lines, airlines. How are they all faring today?
Well, we took a look at the cruise lines and airlines just before the market opened. They were in the red, still in the red. Let's take a look at the NASDAQ 100 and look for some trends here. The big cap names largely in the green. Those are those FANG stocks. Facebook here, notable exception, down about 0.5% here. And if we sort by performance, we can see kind of a defensive setup. So the stay-at-home trade really working out a little bit better now. Zoom is in the forefront, up about 4%. Netflix is up there too, about 1.5%. And then we got some software names, software doing well, BioMarin leading to the downside where we have a lot of weakness in biotech. So that's also weighing on the NASDAQ at this time. If we take a look at the Dow, we can also see a mixed picture aside from some of the big names and the staples. I guess Nike is a standout here. You can make the argument that that is a reopening trade. But we'll just take a look at the travel section here. And we will see that, yeah, these names that we were looking at before the bell, like Carnival, still down 4.5%, postponing its reopening until about September 30th now in American, still off about 5%, Alexis.
Michael, before I let you go, this morning, and this made me chuckle, Moody's came out and reiterated its AAA outlook and its rating on the United States. I get it, but they cited the economy's diversity, dynamism, and the competitiveness of the U.S. economy. Do you think that's folly? Do you think it's time a rating agency like an S&P and Moody's stand up here and drop the hammer on the U.S. and say, you know what, your debt is getting out of control. It's going to hurt that we just downgraded you, but we have to take the step.
No, U.S. Treasuries are still the most safest securities in the world. And then when you look at an economy the size of the U.S. and their debt of the U.S., it's until someone could take you out, it's not really an issue. And I think we could just keep printing money to service our debt, and we could just create kind of as much debt as we want. And if there were a debt problem in the U.S., the long bond wouldn't be at 125 to 150, that sort of range. It would be at 5.5 to 6%. Okay, with this much debt, though, there are long-term. It's going to create so many structural issues for the country going forward, because as the government gets larger, it crowds out the private sector. Okay, and when you manage the yield curve and you have this much supply out there in the market, the velocity of M2, so not the growth of M2, but the velocity, the speed of money is forever slowed. And as the speed of money is forever slowed and the size of government gets so big, you'll never be able to grow at 4 or 5% again in this country, and productivity is forever reduced. So look, the U.S. debt, U.S. Treasury, the long bond's going to stay low. It's still the safest place for your money. I don't know that we're going to negative rates, but if we hit another hiccup in our economy, if there's like some sort of terrorist attack or some other version of coronavirus that hits us, we will be Japan. So the problem with the U.S. is not turning into Venezuela with all our debt. It's turning into Japan, where you just can never grow anymore. So I mean, the U.S. Treasury, they could give it a triple B rating, a triple C rating, a triple A rating. It doesn't matter. It's still the safest government debt in the world.
All right, Michael Lee, all fired up of Michael Lee Strategy. Good to see you. We'll talk to you soon.
Thanks so much for having me.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.